Hello, this is Bob Steele. In this lecture, we will take a look at Chapter 5, Accounting for Merchandising Operations. So thus far, we've been looking at service companies, and service companies can include accounting firms, law firms, and plumbing services. We're charging for our time in those cases. We have the revenue, and minus expenses gives us the net income in terms of these items. The new thing we're going to move to now is, of course, that we are going to have merchandise. So much of the things are going to be the same, and this is how it's going to happen a lot of times when we move forward in the accounting courses. We're going to focus on the things that change. So all of the things that do not change, of course, are things that we're not going to spend a lot of time on. So many of the accounting principles that have been gone over thus far are still applicable here. We're going to focus in on the new thing being inventory. So now, if we are a merchandising company, we're not manufacturing, we're not going to manufacturing yet, we're either the wholesaler or the retailer, meaning we're buying and selling the inventory. So we're buying inventory, we're marking it up, we're selling inventory, ultimately going to the consumer. So in this process, the merchandising company sell products to earn revenue. Examples, of course, will be like sporting goods stores, clothing, auto part stores. These will be examples of the merchandisers. So in this case, if we're looking at the income statement, we're going to have net sales, meaning sales minus returns and allowances. So that's not net income. So don't get that confused going forward. The book's going to say net sales, different than net income. Net income is basically income minus expenses. Net sales is just net from the merchandise that got returned and allowances, which we'll talk about later. Then we're going to subtract out cost of goods sold, which is a new item that we'll take a look at. And when we sell stuff, when we sell inventory, the biggest cost that we're going to have is the inventory that we are selling. The inventory is an asset. Us selling it is moving it from the asset to the income statement, expensing it. The form of the expense will be called cost of goods sold. So cost of goods sold is our biggest expense when we have inventory. Therefore, we're going to make another subcategory other than net income. It's not just going to be income minus expenses. We want to see the relationship between sales and cost of goods sold, and that will be called gross profit. So then we'll take that gross profit and subtract all the other expenses other than the cost of the inventory to get to net income. So for example, on the income statement, we're going to have sales minus cost of goods sold gives us the gross profit. Once again, this relationship is the biggest relationship that we are most concerned about. That's why we're going to have this new subcategory that we did not have in the service companies. Then we'll subtract out everything else we get in order to get net income. Notice net income, not the same as net sales. So reporting inventory for a merchandising. So just to take a look at the relationship of what inventory is, and we can calculate the merchandise available for sale during a time period. So if we think about a month, for example, how much merchandise could we have sold during that time period? Well, we could have sold what was ever in there at the beginning, however many widgets were in there at the beginning of the time period, plus whatever we purchased. That's what we could have sold during the time period because that's what we had at any given time during the time period being a month or so or a year. We can also calculate that by thinking about it, well, we can also calculate it by saying it's the ending inventory, what is still left at the end of the time period, plus the cost of goods sold, plus the stuff we sold throughout the time period. And that will give us this, that's the other side of it that will give us the same number, the cost of the stuff that we sold plus what's still in there. We're going to get to our cost of good equation. If you think about this and manipulate the numbers around mathematically, you can also think of it as beginning inventory plus purchases minus the ending inventory will give us the cost of goods sold. So if you play with this relationship and think about it mathematically, algebraically, that will be the formula that we will be using at a later time. So inventory systems, we could have two systems of inventory. One, the kind of low-tech system of the inventory would be the periodic system, actually. The periodic system records related to merchandise transactions are updated only at the end of the time period. So, for example, if we came in and we sold sandwiches, and we know that we basically came in the morning, we had 5 sandwiches from yesterday, and then we made 5 more sandwiches. We have 10 sandwiches available for sale. When we make the sale transaction, we're going to record it just as we did in a service company, meaning we're just going to record the debit to cash or AR and a credit to sales. We're not going to record the reduction of the inventory. Then at the end of the night, when we count how many sandwiches are left, If there are 3 sandwiches left, then we sold 7 sandwiches. That's when we record the other half at a periodic system. That's the idea of a periodic system. The periodic system, in this case, will be periodic monthly or so, and that means that we're gonna actually count the inventory before we record the reduction in inventory. We're assuming then that the reduction in inventory was due to sales, as opposed to we dropped the sandwich or we lost it or something like that. And then a perpetual inventory system, in that case, we need more sophisticated software. If you go to the grocery store and you ring up the software and you ring up your item as you check it out, notice that you see the side of the sale that says how much the thing costs, which records what we did on the service side when we were a service company, which is the debit to AR or cash and a credit to sales. But it's also doing what you can't see, which is it's recording the reduction in inventory. Inventory being an asset, we're going to have to reduce the asset, so assets have a debit balance, so it's crediting the asset, and it's debiting cost of goods sold. In that case, it's going to track the reduction of inventory as we go. You need a more sophisticated software in order to do that. You're still going to take a physical count at the end to make sure that things didn't happen like shrinkage, some theft, and things like that. So a perpetual inventory system is more up-to-date, gives you more up-to-date numbers before the physical count. The physical count is still needed so that we can check that we don't have any other shortages and losses and shore up our inventory system.